Let's define what a call and put option is and then give you some examples. When you buy a call option, you pay money called a premium, and that gives you a right, not an obligation, but you have the right to buy the underlying asset, which in this case is a stock, but you can also buy call options on currencies, commodities, futures. But we're focused on stocks at an agreed upon price. That's referred to as the strike price for a specified period of time. That's when the contract expires, expiration date or expiry. Now, in everyday life, just think of this maybe as a house. Let's say you found a house that you want to tie up, so to speak, take off the market, and you enter into a call option with the home owner. And let's hypothetically say you strike a deal that says, I'll give you $5,000, Mr. Owner, if you sign a contract giving me the right, but not the obligation, to buy your home for $500,000 within the next 2 months. Because maybe I don't know if I'm moving to that city or I want to keep searching for other opportunities, whatever the case. And the seller is willing to take it off the market, give up other opportunities to put $5,000 in his pocket. And the only other obligation is having to sell the house at $500,000 if he gets a notice from the call buyer saying, yes, I would like to exercise my right. I've just taught you call options in the stock market. So you might have thought it was really, really complicated, but hopefully with that analogy, you now know what buying a call option does for you. In the stock market, we buy them when we are predicting upside movements in the stock with less costs and to limit risk to the debit we paid. I'm going to show you an example. We use these in bucket 1 where we're expecting a big directional move, and we use multiple time frames to give us that bias. Unlimited profit as the stock rises. As the stock rises, then your call option is going to rise. I don't know if some of you remember, it's still going on, in fact, but I personally think it's coming to an end. In Canada, in particular Toronto, they were house flipping, condo flipping by using call options. They would, a potential buyer would pay the deposit to the developer, agreeing to buy the house. Well, I'm sorry, he has the right to buy the condominium at an agreed upon price. Let's say it's $1 million. As the home price has kept rising in value dramatically, many think there's a bubble there now, then that call buyer, that individual speculator who was either thinking of moving into the condo or he did it on speculation, he then can sell his contract. Let's say he paid, put $20,000 down, and then he flips it for $300,000. He just sold a call option. He was flipping his right to buy the condo, not the condo itself, just his right to buy. So the same thing here. We aren't trading the stock per se, but we're trading the call option on the stock, and it goes up in value, just like that Toronto condo example, as the stock rises. Maximum loss anytime you buy options, calls or puts, debit spreads, it doesn't matter. Whenever you buy an option, the maximum you can lose is what you paid for it. So here's our, our little visual here of the call option in the stock market and the homeowner and the speculator on tying up the house. The money goes into the call seller's pocket, and the call buyer has these rights we just described. Here's an example of a directional bullish trade using a long call option. Long means you're buying it. You aren't short the call option, you're long the call option. XLF is the financial ETF, so that represents a basket of financial stocks that we trade as a stock. It had, here's the daily chart, here's our weekly chart. We had a breakout on both time frames, and using basic technical analysis, you look to the left, there's no resistance there. So we think the stock has a lot of room to run. So we buy, stock's trading around 20 bucks here. We wanted sufficient time for the stock to move. We went out a month and a half in this case. That's what DTE means, 45 days to expiration. Call options, we paid $1.21 a share. They were $1.02 in the money, which means they had immediate value. So that 121 is our maximum loss. So on buying 10 contracts of these call options, which represents 1,000 shares of XLF, that only cost us $1,210 to control this $20 stock. If your partner or you instead bought 1,000 shares of XLF, you're forking out almost $20,000. And even with 2-to-1 overnight margin and most brokerage accounts, you're still tying up $10,000, but your maximum risk, it's obviously not going to happen, the XLF's not going to zero, but just to follow along with the mathematics, your maximum loss is your debit, the same as mine. Yours is almost $20,000, mine's $1,200. So I have less risk, less margin, and let's talk about selling these after a nice 24-day run. We sold these calls that cost us $1.21 for $3.70. That's a 205% return on investment with less risk, less margin, and that's an example of how we trade directional bullish call options. The puts would just be the opposite on a bearish side. But we can go through this one a little bit quicker because it's the exact opposite. If you are buying a put, you're paying money for that right, but it's a right to sell the underlying, not a right to buy the underlying at a specified price, specified period, same as before. The only difference, we're using these to capitalize on downside market movements. Same leverage benefit, same limited risk benefit. We profit as the stock falls. Without looking at any numbers, but here's just an example. G-Pro, weekly chart. This was an IPO recently, and this, it rallied, bearish topping pattern here at a prior high, and it looked like a beautiful directional short to us. So we bought in the money core short puts. In the money just means that we are buying a strike price higher than the current price, and we obviously don't have time to give you the whole course now. That's what our option series 10 modules covers in great detail. But we buy in the money options when we have a directional bias because we want to get paid more. And the further in the money they are, the more return on capital that we get for making our prediction. So this had a $40 drop. We wouldn't have stopped out of this until it took out a prior high. Now it's stabilizing here on the daily, so that was a big warning, like, warning, that the downtrend could be over. and made a new low and didn't go very far. So we definitely would have at maximum stopped out here, if not earlier. But still, you got a $40 drop. This is a strategy we sell, as I mentioned to you earlier, even on longer term trades or investments. We make money in the interim by selling options around the longer time frame position. Just for the fun of it, for your learning, in this particular case, that would be called legging into a bearish diagonal trade. Sounds complicated. I guarantee you it's not after you complete our 10 module option strategies course. So that lowers the cost basis of the long puts and generates our monthly income. Now, investors are going to love what I'm about to share with you right now. This is our strategy in our covered call module, number 3. It's actually after we get through the basics of option terminology, how options are priced, we review volatility, then this is our first strategy we're going to teach called covered calls. It involves whether you want to start this as a brand new trade, or for all of you individuals that hold positions for the longer term for fundamental reasons, for tax reasons, for whatever the reason, I don't care. Our job in the seminar, and actually we provide a consulting service to high net worth individuals and hedge funds, that we do exactly this for them. Let me show you what we do. So United Airlines, UAL, let's just assume you bought 1,000 shares here. In selling monthly covered calls, we simply wait for momentum to slow. There's various pictures of that, and we teach you 7 pictures. Any of those 7 things occur, it's time to generate a monthly paycheck. Now, let's walk through this math because it is extremely impressive and compelling. So let's say at A here, it was a gap up, it's extended, and the stock looks like it's ready to take a breather. So this is for you accountants out there, or even people who spend money on a credit card. This is what I call a T account, and debit means you are paying money. Credit means it's going into your pocketbook or bank account. Don't mean to date myself. It's going into your brokerage account, but it's yours to keep. It's profits, monthly profit. So if you buy 1,000 shares here at this price, it would have cost you a little over $57,000. Now, in this case, we're going to sell the out of the money. I'm just going to use round numbers here. The stock's trading at $75. We're going to give somebody the right to buy our stock from them at $78 a share. Now, please let that sink in. It's $3 higher than where it is right now. And we're going to give them that right for only 28 days. Not a whole year, like if you were Liberty Mutual selling me house or car insurance. I'm only giving you the right to take my United out of my account at $78 a share for 28 days, a month. And that's because of option pricing and what's called time decay. We sell short-term options, always less than 45 days, and this is our strategy of bringing in monthly income and lowering your cost basis on long-term investments. So let me summarize again. Bought this, 57 grand. Now here at A, we're put on selling a 10 lot. We're putting $1,420 is deposited into your brokerage account. That lowers your cost basis to 55,810. Everything's fine. It's sideways, perfect timing. Your stock is resting. Now, it tried to break out. It's stalling, major resistance over here. So at B, we're going to repeat what we just did. Rinse and repeat, as the saying goes. So we're going to sell, since the stock hasn't gone anywhere, we're going to sell the same out of the money $78 calls, but they're 30 days in this case because that's where it fell on the calendar. We took in $1,900 in this case, lowered our cost basis to a little under 54. Now think about this. In 2 months, we have lowered our cost basis 5.8%. Ladies and gentlemen, that is staggering if you appreciate what I'm telling you. So, I mean, investors, sometimes they just get so focused on dividend stocks. They say, hey, so, let me buy my dividend stocks for my income. And there's a number of problems with that. One is you're possibly sitting through a lot of pain as the stock is collapsing on you because you own the stock. So you have that risk of capital depreciation. Number two, those dividends aren't guaranteed. When the oil crisis occurred and oil went chopped and so many oil companies almost went out of business, a lot of those dividends disappeared, as did the companies. So you got to use that strategy with great caution. It's our view that selling call options around your long-term investments is a superior methodology for generating monthly income. And you can see the results just dwarf it. And thirdly, as a new trade, so I know I focused on the long-term investor in this example, but guess what? I'm not a long-term investor myself because that's just my personality. I'm a trader. I'm the active trader, not day trader. I hate day trading, except for limited circumstances in trading earnings and gaps and selling premium, which we discuss also in our option series course. But as new trades, I don't own 1,000 shares of stock. This is a phenomenal setup to sell out of the money calls and spreads. So instead of this money, 33.20, lowering the cost basis of this investor, instead, this is my monthly paycheck on just one stock. And if I do this 10 times on 10 different stocks, that adds up to a lot of money on selling options. Let me show you an example of that.